Hi, and welcome to Chapter 31, Learning Objective 2. In this particular learning objective, what we're going to do is to look at um, the relationship between savings, investment, and international flows. So let's go ahead and I'll share my slides and get right to it. At the end of this, we do have a short video. I thought rather than read a whole bunch of PowerPoints to you, it would be so much easier to watch a video. So we're going to do that. Okay, so let me share my slides. Okay, so our learning objective is we're going to take a look at how savings, investment, and international flows are related. So remember, in an open economy, we have the national savings accounts of GDP is equal to consumption plus investment plus government purchases and net exports. Also remember, we rearranged this equation. So I'm just going to do that over here so you can kind of refresh your memory. Plus investment plus government purchases plus net exports. And what we had done previously is we subtracted consumption, subtracted no, that's wrong. We don't subtract investment. Okay, and we subtracted government purchases. And we said that national savings, which is GDP minus consumption minus government expenditures, is equal to investment. Now notice that because we've opened this economy back up, we have this NX, so plus net exports, okay? So you can kind of look at it there. So remember that this was equal to national savings, which we called S. And we looked at it from the tax implications, but now we're going to look at it from an open economy perspective. So that is national savings is equal to investment, and that might be investment both domestic and abroad, plus net exports. Now, net exports is more of a good, and what we want to do is to change this variable right here so that we end up with national savings is equal to investment plus net capital outflow, okay? Because that's like the dollars or the foreign currency, depending on which one it is. So basically, we have a new idea that national savings or savings is equal to the domestic investment, which is I, plus the net capital outflow, which is what you see here. Okay, if there's a trade surplus, again, remember that we're selling more than what we're buying, which is not what we have in the United States. Then our net exports will be positive, which means likewise that our net capital outflow would have to be positive. Now, what does that mean in terms of GDP? It would mean that GDP is greater than domestic spending. It would also mean that national savings is greater than investment. Okay, so remember the S is national savings. Which is equal to GDP minus consumption minus government expenditures. In the United States, we buy more than we sell to other countries. So net exports will be negative because we're buying more than we're selling. What this means is that domestic spending is greater than GDP. It also means that investment is greater than national savings. So savings, investment is greater than savings. Okay, which also means that net capital outflow is negative. Now we call net capital outflow, even if it's a positive thing like you saw up here in trade surplus, this would be that dollars would be leaving. And even though it is positive, we still call it net capital outflow. Here, dollars are staying in the US, and we still call it net capital outflow, okay, even though dollars are staying home domestically. If we have balance, net capital outflow would equal 0 because net exports is equal to 0. So I like this chart. This is table 1 in your book and kind of shows the different types of flows that we could have. So this is the US. We have a trade deficit. Balanced trade. Some countries have that. Trade surplus would be China. Okay. Again, I could paraphrase, isn't the national debt a problem? But I'm choosing not to. So I'm going to go ahead and show you a video. And it's not too long. But the name of the video is the trade deficit a problem? So that kind of fits nicely with what we're studying. And that's really the end of this learning objective. And so I'll see you back in objective 3. Thanks.
The United States trade deficit with all of its trading partners was $500 billion in 2016. That's the equivalent of nearly 3% of the U.S. economy. Is that trade deficit a problem? First, what is a trade deficit? A trade deficit happens when a country's imports of goods and services exceed its exports of goods and services. In other words, when a country buys more from the rest of the world than it sells, the country incurs a trade deficit. What are the economic costs to the United States of the trade deficit? Because the United States persistently spends more than it earns, and because the dollar has been historically strong, the United States must either borrow from foreign lenders or attract investment from abroad. So the longer trade deficits persist, the greater the extent of foreign financial claims on the United States. Those claims take the form of loans that must be either refinanced or repaid, or in the form of U.S.-based assets purchased by foreigners with the U.S. dollars they earn. And those assets can include whole firms, buildings, land, and a few other items as well. If net foreign claims become a very high fraction of the U.S. gross domestic product, the burden of paying interest and dividends and rents and royalties could drain the U.S. economy. Since U.S. imports are concentrated in manufactured goods, a larger deficit translates into fewer manufacturing jobs. But deficits are only one part of the long-term manufacturing job loss. Labor-saving automation and information technology explain most of the decline in manufacturing jobs in recent decades. Today, manufacturing jobs account for 8.5% of the U.S. labor force. In 1970, they accounted for 26.5% of the labor force. Does the United States trade deficit have any economic benefits? Well, yes. The trade deficit brings in tangible resources from abroad for investment in the U.S. economy. Foreign-owned firms operating in the United States pay above average wages, they invest more in research and development, and they enhance the productivity of U.S. companies with which they compete. Larger imports also enable American consumers to purchase a variety of goods at lower costs, dampening inflationary pressures when the economy approaches full employment, which is where it's approaching today. Finally, by buying more from abroad, the United States stimulates the economies of U.S. trading partners, enabling them to buy more U.S. goods and services. Today, world growth is pretty lethargic and in need of a boost. So, is the trade deficit good or bad? Well, the answer is not one-sided. When an economy is growing rapidly or experiencing high inflation, economists generally believe that the benefits from a trade deficit outweigh its costs. But during a recession, or when a country suffers deflation, a trade deficit can do more harm than good. This was Gary Hufbauer, a senior fellow with the Peterson Institute for International Economics.